Fade the rally as stocks are on the verge of crashing. I'm your host, Steve Van Metre, and thanks for joining me today. Bank of America's most bearish analyst is back, this time with another ominous warning. Let's head over to Bloomberg, where we picked today's story up, as B of A says, take profit on the bear rally as stock outflows resume, as stocks and cash see weekly outflows while bonds have inflows. Global equity funds have outflows of $2.6 billion in the week through August 3rd, according to a note from the bank, after last week seeing their first additions in 6 weeks. U.S. stocks had redemptions of $1.1 billion, and while $4.1 billion left cash, global bonds had additions of about $12 billion, the most since November. And strategist Michael Hartnett, who has said the recent rebound in stocks is more of a bear market rally than a sustained run higher, reiterated that investors should fade the S&P 500 index from a level of 4,200 points, just 1.2% above its latest close. He maintains that the bottom for the benchmark is below 3,600 or 13% below current levels, which would really actually cause people to have second thoughts about where this market is headed. U.S. stocks have struggled to maintain their momentum in August after rallying in July on the back of better than feared earnings season and bets that the Federal Reserve will slow the pace of interest rate hikes. The technology-heavy NASDAQ 100 is nearly 20% above its June lows, but strategists have said stocks are likely to fall again until profit estimates see much stronger downgrades. And that is the question now, where are profits headed? Does a pause in Fed rate hikes actually matter, or is the stock market just likely to head lower or higher? Let's take a look at some charts, because we'll start out with the federal funds rate against the NASDAQ 100. And there isn't a lot of convincing evidence that the pause in the Fed will actually be bullish for stocks. We can go back to just before the dot-com bubble burst. We can see the Fed started to pause and stocks rallied back, had a bear market rally, but never got back to the prior high before they came down. Now, how about going into the great financial crisis? Well, stocks were still nowhere near their prior high from the dot-com bubble and continued to grind higher, ultimately before giving up and heading lower. And then we have now where we see the stocks peak before the Fed really even hiked. There's only really one instance where we see this pause, and that was here in 2019 going into the pandemic, where the Fed starts to pause. The stock market isn't making new highs, but then takes off. Of course, we could argue that stimulus money flowing into the markets was a big part of that rally. But what about corporate profits? Well, they're likely to head lower, because one thing that I want you to really understand here is it's not just about the Fed rate hikes, and that's a lot of what investors are fixated on, but there's one part they're really completely missing, and that's the balance sheet unwind, quantitative tightening. And so what the Fed is doing is they're shrinking the money supply. That is what quantitative tightening ends up doing. And when we look at the monetary base, well, that actually shows us where a lot of things are headed. And so when the Fed shrinks the money supply, well, that's the one part that's going to continue even if the Fed pauses. Let's check out this next chart. We've got the Fed's balance sheet or monetary base in blue on a year-over-year rate of change against corporate profits, also on a year-over-year rate of change. And notice how the monetary base seems to lead where corporate profits are headed, suggesting in the quarters to come, as long as the Fed continues quantitative tightening, that profits are headed down. And how about that? What does that mean for the stock market? Of course, if profits are going down, stocks are going down, but now there's overlay the NASDAQ 100 against the monetary base, both on a year-over-year rate of change, and we see they're headed in the same direction. Of course, the stock market being a little more volatile, whereas the monetary base smoother, but still overall telling us the downside pressure to stocks is far greater than the upside. And how about, of course, what this means for Treasury yields? Well, Treasury yields are starting to follow the monetary base as well, although far more volatile in their movements. But here we can see the general trend tells us that Treasury yields are also likely to head lower here. Let's continue on, because Bank of America's Hartnett said that while investor sentiment remains bearish, shorts have been covered. The strategist expects the S&P 500 to trade in a range of 3,800 to 4,200 until the next Federal Reserve decision on September 21st, he wrote in the note. But until then, the risk for stocks is to the downside. And if you're concerned at all what Hartnett's ominous warning means for your portfolio, well, you shouldn't be, because there's a strategy that hedges with bonds that understands what's coming. That's Portfolio Shield. I'll put a link up here in the corner and the description below, because from now going forward, all eyes are on the Fed. And let's see what they're up to. Because Daly says the Fed is far from done yet on bringing inflation down. We need to leave our minds open, she says, for the September meeting, suggesting 50 basis points isn't the only option on the table. Absolutely, she said, and we need to be data dependent when she was on Face the Nation when asked about the likelihood of a half percentage point increase by the Fed in September. We need to leave our minds open, she said. We have 2 more inflation reports, one coming this week and another jobs report. A strong jobs report on Friday buoyed support for another 75 basis point rate hike by the Fed, as policymakers still have another jobs report and several inflation indicators to parse before the meeting scheduled for September 20 and 21st. U.S. employers added a whopping 528,000 jobs in July, more than twice what economists have forecast. But the question is, was that report really everything we thought it was? Well, let's over to our chief strategist, Jeff Snyder, who notes in his daily, to begin with, payrolls bested analyst expectations by an even wider margin, which means policymakers at the Federal Reserve will once again be able to point to a strong labor market number, which they can use to justify a continued aggressive rate hike posture, as well as stave off persistent whispers of recessions. But if you have doubts about the validity, of course, of the non-farm payroll report, well, that's probably valid. And I recently went over and had a chat with Jeff Snyder and Emil Kalinowski on their channel, and you can see this video titled Payroll Report Says U.S. Economy Great. But that's wrong. If you want to take your knowledge even deeper, not only should you sign up for Markets Insider Pro, where you can read about Jeff's thoughts, but check out that video with Jeff and Emil and I, and you're going to see, of course, we're going to expose all the flaws in that payroll report. I'll put a link to that in the description below as well. Let's continue on. Because right now, I think the most important thing is that inflation is too high, says Daly, who isn't a voter this year on policy setting on the FOMC committee. Americans are losing ground every day, so the focus has to be bringing inflation down, and that's a key point here. It doesn't matter what the labor market data is. What really matters right now going forward is what that CPI print is. Even if it comes down into the 8s between now and the end of September, that's still too high. It needs to come down a lot more, and that's their focus. Everything else is just supportive of even further tightening. That could be we get further hot labor prints on the jobs market that's going to cause the Fed to shoot big next time, but probably for the last time, because the bond market is calling the Fed's bluff. As bond traders on a collision course with the Fed over a longer term view, as rates cuts are already priced in by markets that aren't in the central bank's forecast. Wait, what? Wow. Short-dated Treasury Yields have alternately plunged and surged in the past few weeks as investors have tried to determine just how much the Fed will ultimately lift its benchmark and whether it might be forced to follow its tightening with a pullback if the economy starts to crater. And the markets think the Fed is being aggressive this year, means inflation will come down enough to allow the Fed to shift, said Kathy Jones, the chief fixed income strategist at Charles Schwab. The Fed is pushing against this idea because when they are still tightening, they don't want to talk about easing. They've got a big communication problem at hand. And the key point here is the bond market is already telling us that the Fed may only have one hike left, but if they do, it's the last one. And if not, they've already are done. Check this out. As we look at the consumer price index against 10-year Treasury yields, and you can note with 10-year Treasury yields in red, how it leads and often peaks in yields start to lead inflation. You see CPI in blue down, and you can see here again, the yields are peaking and downward trending. CPI is kind of still running flat, and then it heads lower. Yields leading, of course, CPI here. The CPI starts to already roll over. Yields are taking it down. It falls. Here you see it again and again. And now, once again, we're on that same path. And we already know that because the yield curve, which is the 10-year Treasury minus the 2-year Treasury yield, is telling us that this inflation story is coming to an end. Now, when you look at the yield curve with the CPI, you may not be able to see it, but when we invert, of course, the consumer price index, it becomes more obvious that the yield curve is telling us that inflation is soon to peak. And when rates start coming back down, of course, that means inflation's coming down with it. And of course, as we've looked at on our prior show, the federal funds rate as well, signaling the Fed's making a major policy mistake. As far as B of A's Hartnett goes, well, it's called the stocks are coming down. Well, they usually do that when the yield curve heads higher. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.